In highly leveraged derivative environments, the mechanical forces of liquidity sourcing will often override standard, valuation-based price discovery. To navigate this environment, quantitative analysts rely on a specific topography, the liquidation heat map. It reveals where over-leveraged market participants are clustered, waiting to be forced out of their positions. This coin-glass liquidation heat map tracks Bitcoin's price on the y-axis, overlaid with a candlestick chart. The crucial data lies in the background color gradient. Bright yellow bands near $63,000 represent massive clusters of forced market orders. If price touches this, traders are liquidated, forcing automatic orders. By tracking a complete 5-day cycle from July 9th to July 13th, we can observe how algorithmic order flow systematically builds, traps, and ultimately hunts these leverage clusters. These resting liquidity pools exert a gravitational pull on price, creating what we call magnetic vectors. Institutional algorithms tasked with executing massive blocks of orders actively steer the market toward these magnetic zones to absorb the forced orders of retail traders. Analyzing this heat map separates the market's underlying mechanics from retail sentiment. It reveals who is hunting the liquidity and who is about to become it. Starting our dataset on July 9th, initial price action is hovering relatively flat around the $61,000 mark. Just above the current price, short sellers have been aggressively accumulating positions. This creates heavy overhead liquidity, concentrated heavily in the $63,000 to $64,000 range. This creates a natural draft effect. The market microstructure is mathematically drawn upward to absorb this rich, concentrated resting liquidity. Over the next 12 hours, the market drifts upward in a calculated, steady progression. It consolidates quietly just below the target zone. When the price finally impacts those liquidation triggers, the execution is violent. The market spikes directly through the $64,000 band, executing a textbook short squeeze. This triggers a microstructure chain reaction. The first short liquidations force automatic market buys. Those buys instantly push the price higher, triggering the next level of liquidations, driving the spike deeper into the yellow band. This upward sweep successfully neutralizes the short sellers. But by clearing them out, it creates an immediate vacuum of upside liquidity. This initial move proves how price is mechanically pulled toward leveraged targets to fill institutional orders. Moving into July 10th, the post-squeeze market structure establishes a new environment. With the immediate shorts cleared, fresh overhead resistance begins to form. A massive, untriggered yellow band begins to stack at the $65,000 level. This highly visible target acts as structural bait. As price climbs steadily towards this resistance, it tricks retail long traders into expecting an imminent bullish breakout, drawing aggressive late buyers into the market. But an order flow anomaly is forming beneath the surface of this consolidation. Around $63,000, new long leverage begins stacking heavily below the current price action. While the outward narrative looks bullish, the market's internal microstructure is becoming critically top-heavy. The liquidity below is beginning to rival the resistance above. Through July 11th, the price holds a steady horizontal line. All the while, the long leverage below continues to stack, growing visibly denser in intensity. Midday, the market slowly approaches the critical $65,000 resistance ceiling. Then a warning shot. A sharp, localized drop wipes out a minor shallow leverage band before the price immediately recovers. This quick downward sweep is a structural test. It confirms algorithmic access to the lower liquidity pool, testing the floor without committing to a full liquidation cascade. This multi-day consolidation phase represents the active, calculated loading of a massive downside trap. By the evening of July 12th, immediately preceding the collapse, the structural trap is fully set. There is now intensely concentrated long leverage built up precisely between $63,000 and $62,000. The market reaches a critical tipping point. The lower liquidity pool of trapped longs has become denser, richer, and easier to access than the $65,000 overhead resistance. At this exact structural threshold, the market abruptly pivots. It abandons the upside resistance and prioritizes the path of maximum liquidity extraction. The cascade triggers the moment price touches the highest layer of trapped longs at $63,000. The first forced sells crash the price directly into the next cluster of stops. This creates an unstoppable mechanical feedback loop. Selling begets forced selling. Reaching maximum velocity on July 13th, The terminal phase of the collapse completely intersects and absorbs the deepest lower bands near $61,500. In the post-cascade order book, the resting downside liquidity has been entirely cleared out by the sweep. The trap is empty. This drop functions as a deterministic, purely mechanical execution of trapped order flow, localized within the market's internal microstructure. Compare the peak of the upward sweep to the trough of the downward sweep. Both terminal points perfectly align with the highest density heat map bands. Strip away the color gradients to view raw price action, and the exact box-to-box precision becomes undeniable. In this instance, the price targets were established by the heat map days before the actual move, illustrating a highly structured process of liquidity extraction. Understanding order flow topography allows analysts to focus on the resting orders that exert the most immediate physical pressure on price action. Actively mapping these leverage clusters is the only reliable way to predict the market's future magnetic vectors. In the arena of high-leverage derivative trading, there are only two positions. You are either actively hunting the liquidity or you become the liquidity.